Depreciation is one of the biggest tax deductions you can get when you're investing in real estate. But depreciation doesn't work the same with a foreign real estate as it does in the US. In this video, we're going to talk about how depreciation works when you invest in foreign rental properties and what some options are to accelerate and get the most out of those depreciation deductions on your US tax return. Depreciation as a concept is the IRS's way of saying you can't deduct big real estate purchases immediately like you can with some other expenses for a business. Instead, you have to depreciate that property over time. So there's different types of business deductions, right? And a rental property at the end of the day is a business and it has business expenses. So your ordinary business expenses with the rental property, let's say maintenance, cleaning, things like that, those are ordinary business deductions that you deduct immediately. With things like real estate and capital improvements to those buildings, the IRS says, no, we're not going to let you deduct that immediately. That's the concept of depreciation. And the IRS specifies what that time period is. So if you have a single family home rental property in the US, you can depreciate that property over 27 and a half years. And they have modified accelerated depreciation where you can take the depreciation earlier, a bigger percentage of it on the front end, and it starts to taper off over time. When you invest in foreign real estate, the IRS has more specific rules, or at least less flexibility. You have to use what's called straight line depreciation, or ADS is the technical term. And for residential rental property, it's depreciated over a 30-year period. So simply put, if you purchase a property for $100,000, you divide $100,000 by 30, and you take that as depreciation expense every year on top of your other business expenses. That can be a huge benefit, obviously, and probably the biggest missed expense deduction on people's tax returns, especially when they're planning, right? Because we all think from a cash perspective, like, did I have net positive cash flow from this rental business? When depreciation is not really a cash flow question on an annual basis. And so a lot of times you can be, because of depreciation, you can have net tax loss, but net cash flow positive in an annual period. So on top of just getting the depreciation deduction, we also want to see how we can maximize that. And you have a lot of flexibility in the US with that. So the IRS has different categories and different useful lives for different categories of assets. So the building itself and the main components of it have that higher useful life. So 30-year straight line depreciation that you have to use. But other things like furniture and equipment and things like that have lower depreciation lives. The furniture you can write off over a 7-year period, or in some cases, certain items you can write off in a 5-year period or a 10-year period. It just depends on the type of asset that you have. And breaking down your property into those individual assets is a concept called cost segregation. Cost segregation is an extremely powerful tool to maximize your depreciation deduction on an annual basis. When you're dealing with a US property, it's even more powerful because anything that you can get outside of that real estate, that 27 and a half year building property life, you can actually use what's called bonus depreciation and get 100% written off in that initial year. So if you can break out things like furniture, electrical, HVAC, things like that, you can get all of that written off year one and just leave the bones of the structure itself in that 27 and a half year. When you're looking at foreign real estate property, there is no bonus depreciation. So that takes a lot of the bang out of the cost segregation, at least that immediate write-off, but there still can be some benefit there. For example, just getting certain assets out of that 30-year straight line can increase your depreciation expense over time. So in a lot of cases, it's not as big of an effort for the cost segregation study because we're not going to get that bonus depreciation on the front end. But the things that are more obvious that we can pull out of the 30-year life to 5-year, 7-year, just to give you more depreciation deduction, is worth the effort in most cases. When you're looking at depreciation deduction, the first thing is make sure you do it correctly and do it according to the international rules, so the ADS depreciation rules. But secondly, don't just assume that you stop there with the 30-year property. We can break this down into better depreciable assets that we can write off earlier. Now, the other thing to keep in mind is don't pay someone to do this cost segregation study just because it's going to give you more deductions. Make sure that you're actually going to be able to use those deductions and that it's useful to you, right? Because we have plenty of other videos walking through how rental real estate activity can be subject to passive activity loss rules and other things, and we'll link those videos in the description below. So the first thing, and the clients that this makes sense for, are people that are earning net income from their rental business that they're being taxable on. In that case, for sure, we want to maximize the expenses in year one that we can get each year. So we're going to be milking as much as we can out of that depreciation deduction through a cost segregation study. The other people are the ones that meet the short-term rental exception or real estate professional exception, where even if there is a loss from the rental, they're able to take that against their other ordinary income, like wages and things like that. So those are the scenarios really where I see, from a foreign real estate perspective, being the most beneficial to look at these cost segregation studies, is if you meet the real estate professional rules, short-term loss rules, or if you have net income and you just want to lower your overall tax liability. So if you have foreign rental property, if you're just getting into it and investing in that, or maybe you've had it for years and not sure you're doing your depreciation right, reach out to us at McGowan Tax. I'd be happy to look at your specific situation to see how we can get the most out of your depreciation deduction each year.